Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Welcome back to Carolina Commercial Real Estate Connection. Today we have Patrick Stoy with us. Patrick owns MC Capital here in Wilmington, North Carolina. Patrick, thank you so much for joining us.
Hey, thanks for having me, Tony. Appreciate it. Cameron?
Yeah, man. Thanks so much for being here. We look forward to hearing your story.
Yeah, absolutely. Yeah. So let's start off with a quick background on you and a background on your company, Patrick.
Yeah, my background is my grandfather, who I grew up with out on a farm, was also superintendent for a construction company. So needless to say, as a young child, I was working in the gardens and then going to job sites and being around construction at a very early age, and really taught me a work ethic at a very young age to work hard. Really kind of where it all started. If I go back and look at the what's pivoted me and got me here, I would definitely say that my grandparents have helped out a lot just from teaching me the work ethic side. And then also the most interesting side is teaching me what not to do. They had some great opportunities where they lived in Charlotte and had opportunity to buy land right across from the Charlotte Motor Speedway now compared to the farm that we own. So that was lesson number one. My grandma wanted to be a little further out. Lesson number two is my grandmother growing up in the Great Depression. She wanted the cash immediately because they had lost everything. And so my grandfather was actually for Food Town, which is now known as Food Line. He built the first store and they gave him the option to take stock or cash. And of course, my grandmother said, take cash. And now Salisbury has more millionaires per capita than anywhere in North Carolina. So missed that boat. And then, the third story that sticks in my head is that they had bought some lots out on Baden Lake, and they didn't want to be on the water side because they were scared the kids would get out there in the water and have an issue. So they bought them on the inside. So needless to say, I still own that lot now. Pay taxes on it every year.
Sounds like a lot of good moving and shaking.
So it was, out from a work ethic and also from a take risk. Don't let an opportunity mess you up. And it's interesting. We always learn from people, but I learned what not to do. Like, don't miss out on opportunity. So that's kind of a background of just, getting started in the finance industry back in 99 and opportunities that came across where my first deal was learning how to wholesale a single wide to moving on up to, buying my first house and then turning that into a rental to starting doing some fix and flips, got involved in a mobile home development project, which ended up being a 15-year journey at this point. But that's really what got me learning and understanding that you can create a lot of wealth through real estate, which kind of led me to our private capital side later on in my mobile home journey when we had the bank, after we had made all of our payments on time and put the development in, put the water and sewer in, and they kind of decided they did not want to have a mobile home park on their books anymore. So I was able to go find some really hard and cruel money to borrow to get that taken care of and paid off, and went through that. And just at the end of that experience, was able to really understand, like, there's got to be a happy medium here. There's got to be that it's a win-win for everybody. And so really kind of started looking at the aspect of how can you do this to where it doesn't take advantage of people, but it helps move them forward. So took a little bit of rolled over to a self-directed IRA. Really scared at that point. Like, all right, I'm taking my retirement money, going to go risk it on somebody else, which at the end of the day is amazing because he's doing really well at this point. And I learned how to do this a lot better of how to do it, and literally have taken it to where I just rolled over my self-directed IRA to where now we've got a whole network of friends and family that we literally have helped, probably done, lots and lots and lots of deals that have helped people literally create wealth that they are able to quit their W-2 job. And that's what's exciting is just watching other people's journey move along to where they were, we could say a slave to the man,
Yeah,
basically, to where now they actually have the financial freedom to be with their family and have their time and building their own empire. I know that was a lot.
That is,
but-
well, and that's what's so cool is your journey. There's so many different facets that we could stop and probably have a show on each one, on
Yeah.
how it went, so that's really cool.
Yeah, I mean, you have sounds like a great wealth of experience in going through and starting all this. So let's kind of break down and get back into every little thing you've got. So the first thing you did was some wholesaling, you said, right?
Wholesale single wide when I was in my early 20s, needed some capital. He said didn't come being from a farm family. We grew everything, we ate everything. There's never really a lot of capital. Needless to say, it's very simple. And so not coming from a lot of money, I was trying to figure out how to make money. So went and educated myself on how to do a wholesale, was able to wholesale a single wide, which that pivoted me into being able to buy my first home for myself. Back in the days of a 95% no doc loan, 5% down, you just had to come up with the capital as long as you had good credit. So I was able to buy my first house from that. And then after living there for a couple of years, I was again scared. So I turned it into a Section 8 house because, at least I knew it was guaranteed income compared to having a renter that, may or may not pay me. But that was my first venture into being a landlord from that aspect. And then from that, just kind of moved into buying some investment properties through different ways, contract for deeds, working out some seller financing, just different options that came across that people wanted to get out of things or just didn't, just didn't have the desire to be a landlord anymore. And I was just looking to try to grow wealth and just knowing that, 99% of the wealth in this country is through real estate. I just knew that was the right path, but just always had to figure out how to put the deals together. There's always a way.
So, and I think that's the easiest way to, sum it up. You were definitely creative, it sounds like, from the very beginning. So doing deals, going straight from a wholesale, where that was your first thing you ever did, to then taking the first house you ever had and turning it to a Section 8 rental. Like these are not easy things to understand, getting a house and turning it to Section 8, wholesaling a deal. Did you go to a class or did you just, try and say, oh man, I'm going to wholesale?
Nope, I did. I went to a class, so, education. I went to Catawba College, played football there for a couple of years. So I'm going to say my education was more focused on college and sports and learning a lot. Left there and just knew that I needed to be educated in something that was going to create real estate. So I literally just read. I mean, I'm a big reader. I remember the first book that I ever read was called The Wealthy Barber. It's just a story about a barber that, explained the story aspect of thing. I think I learned better by stories more than text and trying to memorize things.
Yeah.
It's a little more entertaining that way. And then just from that, just really tried to immerse myself in reading a lot and going to, just any kind of events that I could get education on, and then how to put those into practice.
Cool. So I've got a question for you. So for anybody who doesn't understand contract for deed, can you go through when you did that process? What did that look like and how did you set that up?
Yeah. So basically what I had a couple that they owned a duplex down at Riceville Beach that they just didn't want to deal with it anymore. The values, they owed more on it than what it was worth. They were tired of managing it. And basically you end up doing is getting under a legal contract that's recorded at the county courthouse that basically states that you are overtaking the liability of that liability, and you are going to be responsible for all taxes, insurance, and also the maintenance and management of that project, basically. So it removes them from it. So in that agreement, the way we did it to make it perfect, we just started it January 1st, because that way they could have filed their taxes and their expenses against that property going forward on January 1st of that year. I was literally responsible for everything to do with it. So finding the tenants, fix anything that needed to be fixed on it, the HVACs, just really, arbitrage basically from a way that the underlying debt was already in place. overtook that payment. And the little things that you do, you want to make sure that you put, your address on the mortgage statement. So it's coming to you that you're making that payment directly, because you don't want to give somebody else the money and expect that they're going to make the payment on it. So that's probably one of the first things that I would say that if you're going to do a contract for deed is change the address of where the statement goes to, because the mortgage is still staying in their name. So it's in our legal document, we actually had it that if I missed a payment, that literally it would convert back to them. I mean, that was the agreement, that I would not, miss this payment. I knew that it was something I wanted to do, is to do the contract for deed on this. So did that for a couple of years. Got it sold. The good part about the contract deed, I had a cash buyer, so it made it real simple. We just all had to sign off on it. So I was able to make my spread from the amount that I owed on it compared to what the sales price was.
So at the time that you did the contract for deed, they were basically underwater, so they weren't making
Correct.
enough. So your value add is what made the value, or was it a time thing?
Correct. The biggest thing for them, it was going, they had it on an interest only loan for 10 years, and it was going over to a principal and interest payment, and they just were on a fixed income, and they did not want to have to deal with that extra expense. So that's where, just kind of looking at the deal, I said, you know what, I'll go ahead and take this over, knowing it was going to be an investment. So they didn't have to worry about that interest only payment going to a principal and interest, which is almost double what they were used to paying from a cash flow perspective.
And then when you exit, they're already out. So you're
so let's stay in here on a little bit. So when you take over the mortgage payment, do you have to get approval from the bank? Because the bank is going to now send you the loan payments. And do you need to get approval from the bank? Did the bank underwrite you for taking over this?
Nope, not at all, because the underlying security instruments there, they had never missed a payment. So alls we did, literally the statement would come to my house with their name on it, but it had my address.
Gotcha.
Is all it was.
So they just called in and did an address change.
All it did is an address change. So that's one thing. There's a couple of things you want to do to protect everybody. At the end of the day, I always try to put deals together that everybody is winning. That's what makes it work. So in that perspective is that I was going to overtake this payment because they had no way of getting it refinanced because of where the value was compared to what the balance was. So was able to not affect their cash flow where they didn't have that stress. It gave me an opportunity to have an asset that I can manage and add to my portfolio of rental properties. So outside of the contract for deed being recorded, that I had provision that if I missed a payment, they automatically got it back, even though I'd been beating down the principal. And also the other thing that you want to do to protect yourself is you want to make sure that you put yourself as a second loss payee on the deck page. Because if something was to happen to that property and your name was not on there, guess who's getting the check? No matter what the agreement was, when there's a couple $100,000 flying around, or even $10,000, it could lead to a rough conversation. So just in the contract for deed process, you want to make sure that you've got the statement coming to your address, so you know what's made every month. And you also want to add yourself as a second loss payee to the insurance, because they have to maintain the insurance in their name because they're the one that's also on the mortgage. So you can't go and change your own insurance company.
Because then the mortgage company could actually call it due.
Well, I don't know if they call it due. At the end of the day, we were doing a deal where the payment was still being made. And we had a provision that if I missed a payment, it would go back to them. So I think at the end of the day, they would have probably just said, hey, what are you doing here?
So in that initial structure, you set a purchase price for the property that you were buying it from them from, or giving yourself an option to buy it at a certain price. Am I right on that?
Well, it's not an option. It actually is a contract for deed. So I overtook the balance that was owed on it. So let's just say it was $700,000 owed on it. And at that time, they had 10 years of interest only payment. And that's why they were using it for cash flow. Well, that was changing, and they just didn't have enough money because it was now an investment property for them. It used to be their primary residence. So now the loan to value would have caused them to bring literally $100,000 or plus to the table to refinance it. And so basically at that point, I just said, hey, I'll overtake the new 20-year amortization based off of that balance and be responsible for that payment.
So you bought it for what they owed.
About exactly for what they owed. They just did not want to bring money to the table. They didn't want to deal with it anymore. So it worked out. It worked out well for everybody.
And when you're walking into a deal like that and you're saying they're upside down on the house, so when you're taking over, let's say, keeping with this $700,000 loan, percentage wise, what would the home or the townhome have been valued at?
750 at that time. So there wasn't,
Okay.
if they literally tried to put it on the market, they would have sold it. By the time you pay the agent commissions, they would have got out for what's owed on it. So, they really were just, it's funny working through people, we develop a relationship and we tried to figure out how to make it work for them. And it just didn't work. And I just proposed it to them as hey, what do you think about this idea? Because it was no skin off their back to just let me do it, because they would have walked away with the same amount at any given point anyway. They would have walked away with nothing. So it was just a perfect opportunity essentially for me to walk in, because they would have not walked away with anything anyway.
And then the upside for them is if you don't make the payment or you default in some manner, then they get the note back, the house back fully in their name, and then can potentially benefit in 2 years from now that you don't pay it.
Correct, with a less principal balance owed on it, because I was hammering down the principal at that point.
And then when you sell it and the upside, when you're saying you have a second loss payee on the debt. So in essence, you were taking it for the outstanding loan amount since it was barely worth any more. And that was basically break even. It's what you're in essence buying it for. And they'll say you, in that same circumstance, you sold it for 900, you get all the upside and that's in the agreement.
Correct. Yep.
Right. So awesome. I
Yeah,
think
that's pretty wild. I mean, it's funny, like I said, there's so many pieces to that, because then when you go and sell it, they're still on the mortgage. So they have to sign.
They had to sign off on at the
At
closing.
closing, yeah.
Right.
Interesting.
and see that you turned the whatever profit, they get to see the profit that you turned. But like you say, it's taking over a headache. So
Mhm.
that is, there's in commercial, there's such a thing called where you have multiple tenants called a master lease, which is similar to something like that. In essence, I would say that could be a contract for deed type of situation, right? Where you would guarantee them the same amount of payments, whatever you say the payment amount would be, either equal to what there is now or adding more in a certain time frame. But in that circumstance, I think you're setting a purchase price at the initial contract stage,
Yeah.
if I'm right on
Yeah,
that.
yeah, it's just saying that price and it's a contract for deed. So it's kind of different than I think a lot of people call it subject to right now, where the contract for deed is literally, this is a contract that I will own the deed once it's paid off.
Right.
So that's why I like to call it the contract for deed.
Do you got all that, Cameron? You got any other questions about that?
Oh, I got it all. I've already made 3 calls right now. I got 2 things under contract.
And Cameron's been over there
Yeah.
texting, making deals go.
No, it's kind of and it sounds like, almost the same in the commercial. It's a distress situation. They weren't necessarily in trouble, but there was really no upside for them to have it.
Right.
So
So
it-
there was
you know-
just, they'd already done what they'd been cash flowing for 10 years. They had everything that they needed from it. It served its purpose. And now it was just how do we get rid of it?
And you found them, how did you source them? Were they coming to you for refinance information, and then that's where you led to the relationship?
Yeah, they were business owners and we
Okay.
had done some other things, and just relationship wise, they kind of brought it up. Here's what we're dealing with, and just worked it out. I think that's probably one of the reason at the end of the day, they did it with me, because we had already had a relationship.
Yeah.
It wasn't me just, hey, what do you think about this idea
Yeah.
without knowing you?
Yeah.
Yeah, I think that's great. And the other thing is, this is direct to the source. It's a little different, it's hard to get into investing for a lot of people because you have to network through, and it's really, you're not going to drop into a deal like this looking on the MLS or, searching online through the real estate. It's all about networking and, personal relationships with people in order to build that trust, because that's really a big trust factor of somebody giving you that opportunity to do that.
No, it does. And that's where it literally goes back. I mean, you got to pay your dues. Nothing's going to happen quickly. I mean, you really just got to, do this, start off with the wholesale, start learning how to do investment stuff, start, just talking, just getting out there. And once you start getting out there and people know what you're doing, when something comes along, they know you're not taking advantage of people. They're like, hey, he's really trying to work it out. That it really opens up a lot of opportunity for transactions.
Well, with that, let's back up to the wholesale. So tell me the whole, I've never done a wholesale project. So when you had a single wide, tell me how that you kind of flowed through the wholesale process and what that means.
Yeah. So basically what happened is in that scenario there, it was a It was a single wide that needed some rehab done to it. So I basically went to the seller and said, look, if I rehab this property, because that's all I could afford at that time was, basically getting under contract that I would spend, I think you probably spent about $5,000. So I probably got under contract. I'm just gonna do some rough numbers, probably got under contract for $20,000, just, let me get it under contract. I'm gonna come in here, I'm gonna fix it. And then I was able to find an end buyer for like 35,000. I mean, like, we're not talking big numbers here. I mean, I think I walked away with like $10,000. That was the most money I'd ever made at 20 something years old, with a son on the way coming. So it was like, a big thing for me, that it was got under contract, went there and fixed it up, found a buyer for it. They were able to arrange financing, bought it from me, and walked away from with $10,000 on it.
And they bought it from you before you technically enclosed to own it.
Correct.
Okay,
Correct.
gotcha,
Yep.
gotcha.
I
That was the whole thing.
basically got under contract, fixed it up, and then sold to them as the end user. So it was just a same day closing with the attorney. Basically, I bought it, sold it, and then the end user's money is what actually paid off the seller.
Again, education. So that's you going to
Right,
class
yeah,
learning
and
this.
that's gotten a lot, more mainstream now. Back when you did this, and you're saying, I think this was in '99. Now that's all over. You're all over the internet. People are getting things under contract. They're throwing them on Facebook, throwing them all over the internet. But you didn't have all that at that time, right? So at that time, you had to go network around, tell and talk to 50, 100 people to find somebody that was a cash buyer end user that could close. Otherwise, you can get this under contract, have done all that work, and maybe didn't have the money at that age to close and could have lost everything.
It's the risk. I mean, that goes back to my grandparents of what not to do,
Yeah.
learning that at least try to make every opportunity work. I mean, you can create your own luck.
Right. Yeah, absolutely. So, yeah, I mean, I think wholesaling is great way to get into the business for somebody that doesn't have a lot of money.
100%. I mean, that's when we talk to people every day. I always try to figure out, what do you have? What do you really have as your assets right now? Because you're either going to start off from, if you need to build up your assets, you either need to wholesale because it's easy to get under contract. You're going to do some hard work, or you need to do a fix and flip, because there's no point trying to build a rental portfolio if you don't have, and everybody has a different number, whether it's 20, 30, 50 that's put away that makes you sleep well at night and not be stressed. Because at the end of the day, it's all about not having the stress, because we still need to be able to function at a high level and not have that level of stress. So and I've gone through that. I had a goal to be a millionaire by 30, which I hit, but it was all net worth. Right. I didn't realize it. And then from 30 to 40, it was still at $1 million. I'm like, wait a minute, what am I doing wrong here? And so it really understood, what I really got to understand is you got to have an equal balance of cash net worth and net worth, because having just all net worth that you don't have access to it unless you literally have to sell it or forced to sell it, that's not being
right.
balanced.
And the thing is with net worth is it's a balanced number, but typically when you try and cash that balance, right, it's not that easy to get. So that net worth is a great number to look at. People are always like, yeah, the net worth, look at your net worth. Net worth. But then if you have to fire sale to get to that money, to access that money, you're probably not going to get that. Right.
Yeah.
So, there's a lot of kind of movement in that number that people would want to build it up, because you'll say, well, this is worth this much, so this makes my net worth this much. But then if you get in a bind, and typically when you're in a bind and you got to sell it, you're taking a lot less than what it's actually worth.
I'm a multimillionaire because my trailer that I bought is now worth $2.5 million. I can't sell it, and that's what it's worth. To your point. So that
But
makes
that
sense.
comes with how many acres of land?
Oh, yeah. Quarter acre.
But I mean, that's really the lessons to teach people is you've got to build your cash net worth at the same time that you're building your net worth. And it's not literally sitting it in there in cash. It's having it in a stock portfolio that you can put a line of credit against or something like that, that it's still working for you as another wheel on the bus.
Yeah, that's fantastic. So let's get into a little bit of the other stuff. So you do, with your capital company, go through a little bit of who you work with typically and what services you offer.
Yeah. So, I mean, we're small. We actually like to start working with people that are just getting started or have just a few under their belt, because at least it gives them an opportunity that they usually wouldn't have. So we have started off with one gentleman that literally started off with a double-wide manufactured home, which he couldn't find anybody that would give him private capital for a manufactured home transaction. So we've been able to work with him from day one. Him and his dad actually work together. They've been doing everything that they needed to do, and they have literally over the last 3 years gone through and been able to fix and flip mobile homes. They actually just closed on a 18-unit apartment complex where he bought it right, is rehabbing it right, and is walking in. We're literally, I mean, we're funding him 100% on the total project because he's creating that value add into it. So literally, I want, as long as you're willing to put the work in, find the deal, and really just bring it to us and let's make sense of it. Our job is to, make sure we're protecting the gold basically of our capital that's moving, but we also want to make sure that it's going to be successful for you at the end of the day. I mean, we'll do a subject to appraisal, make sure that we're under 75%. So, if you're buying it for 100, you're rehabbing it for 50, and it's the ARV's at 200, that's perfect. I mean, at that standpoint, we'll literally finance you 100% of that transaction because we know that the purchase price is right. We've got everything on a draw schedule, and we've got the capital held back to finish the project. God forbid something happened that you weren't able to. We've got it there that we can finish the project. So just trying to put all the safety guards in place for everybody.
I think I'm switching. I'm going to start just using him to, I'm going to go fix and flip right away. So,
Right, absolutely.
Yeah, that's a great. I mean, that's really good. That's really
good. I mean, have you seen in this market? I know that was booming 2 years ago, the fix and flip. So have you gotten in any trouble? I know some of the guys that I know that were in that, lending environment have had some troubles, I think, on some of the guys that were into it newer. Have you guys stayed pretty consistent? I know, what markets do you all work in?
Yeah, no, I mean, for us, it's a relationship. I mean, I really spend some time getting to know the person because literally I always call it kind of getting financially naked. I mean, I need to understand who you are first. Let's have that conversation first. Right. Then we can talk about and be project specific. So really get to understand who they are, and we'll give them the recommendation that if they don't have access to capital, they don't have capital, you need to get something in place, understand what we're working with, because I want to make sure that if something did pop up, that they have a way of fixing it. I mean, we don't want them coming back to the well, needless to say, like, oh, now this popped up. So we always try to make sure that there's something there that they've got access to that can give them some capital.
So let's do this. Let's walk through a potential deal and understand how something like this is structured. So for an example, let's say we've got a 4-unit multifamily deal that we found. The initial price that we're seeing is that they're selling, it's $350,000 on a multifamily deal. And we've walked through, we're budgeting a renovation of $75,000. And you've talked to me a few times, don't know much about me, but you've talked to me a few times, and this is the deal I'm bringing to you. I think the after repair value of this is $550,000. So 350 purchase, 75 in renovations, and 550 is the after repair value. So walk us through, somebody's coming to you like that. Walk us through what are your steps and how does that work?
Yeah, I mean, so basically right off the bat, just, hey, do you have experience doing this before? Have you ever done this? Or is this just something that you're wanting to do? Because if you're going to go tackle a big project like that, I will sometimes walk people back like, hey, why don't we do a single family first? Real simple, real easy. You can always get rid of those if you have to. So that's the first thing I do is, what is your experience level? Just really finding that out. From that, finding out what assets they have access to. Do they own their house right now? If they have equity in their house, which everybody's been, over the last couple of years, everybody's been gaining equity. If they have equity in their house, if they look, go get a home equity line. Introduce you to somebody. At least I know you got 50 grand on a home equity line. If you run into something, you're not going to be stressed out about it. So just understanding what they're working with. Do they have money in their checking savings account? Do they have money in their primary residence? From that, what we'll do is get it under contract. I always tell people to go get a home inspection. Even though your contractor is going to go out there and give you all the cosmetic things they're going to do, that home inspector is going to be the one that finds the things that nobody can see. So get it under contract, get your home inspecting, get your cosmetic stuff done, give it to the contractor, find out what the total cost is going to be. From that, we're going to take that and we're going to go do a subject to appraisal with an appraiser. And basically in this scenario that you had, I think you said 550. Mm-hmm. And so 75% of 550, anybody good on math here?
I got to carry the one. I got to carry the one.
So
$412,000.
All right. So $412,000, that'd be our loan amount. max loan amount that we would give you. So you're purchasing it for how much?
So this is
So we're at 425.
It's 350 and 75. So we're 425. So by your math, we would only have to come out of pocket 12,500.
Correct. Plus your closing cost.
Yep.
Yep. So very minimal into it.
Yeah.
Because we're going off that ARV, and I always try to find out, like, look, are we doing this as a fix and flip, or are we doing this as a value added rollout to a DSCR loan or an Airbnb loan or some kind of commercial loan? Because that exit strategy kind of determines too where I need to be. Because if we're going to be where we're going to want to roll it out, I'll probably pull it back a little bit, like 70% to 72.5%, just because I need to leave some room to be able to put the closing cost into the refinance of it.
Gotcha.
Okay. And so if somebody's doing one of these and got a 75 rehab budget, walk us through how that works.
So basically what we're looking at is at the closing table, we're going to take down the purchase price, pay off the seller. We'll go ahead and we will supply the capital to buy the materials. And then after that, we already had a laid out project timeline of when you were going to be expecting draws. And so whenever you're expecting your draw, because after that, it's on a work completed basis. You know, we're not going to give you the money and going, good luck.
Yeah.
Yeah.
See how this turns out.
Their initial scheduled timeline, and every time they request a draw, you send a third-party inspector, I'm assuming, to go through and verify work has been completed, materials are on ground in order to release more money.
Correct. Yep.
Awesome. And then you guys carry the loan after the renovation?
So
Or do you
after the
sell it?
renovation's done, if they're fixing and flipping, of course, they're selling it, they're out, we're done with it. On the commercial side, I have different investors. So we're a broker when it comes to that, a commercial broker. So we have institutions that we work with that will do 30-year fixes, 40-year fixes, interest only, just lots of different products. It just depends on what the capital markets appetite is. But the good part with those kind of loans, we only look at the project. We don't get into their personal income. It's all about the cash flow of that property, period. So,
So that helps the new person that doesn't have that whole huge, like you were
Correct.
saying before. Okay.
correct.
Yeah.
And we tell people, like, look, I mean, if you're just using this to the value add and you're bankable, go to the bank. They're going to give you a 5-year arm on a 20-year amortization with a great rate. Most of ours are going to be to where they're set it and forget it loans. Most of them are going to be anywhere from 20 to a 30-year fix. It's going to be where you never have to worry about requalifying, because that's the one difference. I mean, I kind of brought up that on my mobile home park that, you know, having a bank call your note sucks. There's no better way of putting it. No matter, I've made all my payments, done everything I'm supposed to do, and now you're telling me you want me to write you a check for millions of dollars and I don't have that. So from a learning lesson standpoint, I always try to look at the difference between what can you get. And I have some good relationships with banks that I literally will send people there, go get the terms, and knowing you're going to have to requalify for that every 5 years because it's a balloon,
Right.
compared to what does it look like that if you can set it, forget it, and never have to worry about it again? What is that spread, and is it worth it that you can just be done with it?
Yeah. People's, you know, appetites and financial situations change vastly in 5-year periods,
Yep.
right?
5 years is a long time.
Yeah.
And not having to requalify is huge, because I mean, you don't really, you may be going a completely different direction anyway. So, you know, looking at that piece.
Yeah, and a lot of those loans can be assumable too. So,
Right.
which is the good part of it. So even if you are, if you put it in place and you just say want to exit it, I mean, the issue always is the difference between where you want to sell it compared to what's owed on it. That's kind of the thing with assumable loans, is the seller going to make up that difference, because we still have to qualify them at the end of the day. But that's always the bad part about the assumables. How do you make up that difference? Because nobody really wants to step in on a mezzanine or second financing on a purchase.
On a purchase. Yeah.
Right.
Yeah. And that's a lot of what, you know, the expectation is right now with the commercial mortgage market right now. There's a ton that are coming up, you know, with these balloon loans that are be coming up in the next year to 2 years. I don't know exactly what the latest is, but we've brought that up before. So that's going to create a lot of pinch in that market. So, you know, with what you're seeing, do you see anything on the horizon that gives you pause?
Well, I mean, from that standpoint, with the banks pulling back right now, and some bankers that I know and I've talked to, I mean, needless to say, they're pulling back to like 65% on projects and stuff. And I think we've got 25% of all commercial loans are coming due here in the next, 18 to 24 months. A lot of that's going to, bring in the opportunity for partnerships to be established. is kind of one way that I see a lot of that happening. Just from a standpoint that people have had these projects for a while, and maybe they're wanting to bring in a capital partner to basically, hey, bring in some capital, pay it down to the new loan to value that the banks are going to be at. And again, who knows what they're going to do? I mean, they can set their own rules at any given moment, but at the end of the day, they still got to make yield for their customers and keep those deposits moving. So hopefully we won't see anything crazy happen through that it'll keep the commercial market stabilized. But at the end of the day, it's like I said, it's just going to be about the relationships that you have with the existing people you have or are developing, and that there may be some opportunity that arises.
Yeah. Awesome.
Yeah, that's really good.
So what are you looking to help people out with right now? Are you still focused on mainly fix and flips with residential homes? I know you're doing some apartment deal. You just said an 18-unit apartment deal. So if people are looking to connect with you and maybe work deals with you, are those your sweet spots?
They are. I mean, I would say that predominantly the fix and flip is a big piece of it, because that's where you're going to get the deals these days. I mean, you're not going to find something on the open market that's a deal. I mean, if you're going to create some sweat equity, it's going to be because you have to do some work to it. And so it's either helping people create that cash worth until they can have enough room to do the net worth, or if they've already got their cash worth, expanding their net worth through long-term holds on these, or Airbnb holds, stuff like that. But we don't, we look at everything pretty much 35 units and less is really our market. Because once you get above 35 units, you kind of start getting into the big boy world. So our specialty, I guess, would be the small fix and flip up to the 35 unit or less apartment complexes.
And do you have maximum loan amounts that you're looking at for people? Or is that just based on the
capital
individual?
markets? Yeah, it just depends on the capital markets and what their appetites are at that point. It's always changing. I mean, the thing about a commercial deal, I mean, you go into, it's not like a residential deal that you just quote the rate and here's what it is. A commercial deal is literally when all the pieces are pulled together. Okay, here are your terms now based off of, the DSCR, the cash flow of it, and the expenses that have come up. So I always tell them, like, look, I mean, going into it, here's what we're expecting it to be at the end. There's always going to be something that pops up that's in the middle, but it's just about communication. And hey, here's what changed, and here's why, and here's what the new terms will look like. And sometimes it can get better, and sometimes it can get worse.
And what areas do you guys focus on?
So for fix and flip, I like to stay here in North and South Carolina. I grew up in North Carolina, so I kind of got somebody all over the state that's a contractor somewhere, all the way from Boone to Charlotte, to here. And then for our DSCR and Airbnb loans, and even some of the bigger institutional projects, we pretty much do all across the country. I think there's like 2 or 3 states that are like, North Dakota or Wyoming or something like that we just don't, the population is not there to do those for the institutions.
Cool. So if people want to reach out to you, what's the best way to get in touch with you?
My cell phone number is probably the easiest.
What's that?
910-200-8859.
And what's your company's website at?
mccapitalfunding.com.
Okay. And are you on social media at all?
I'm on my phone a lot.
Yeah, it's phone's gonna be it. The text.
Yeah, I mean, it's just
texting on the phone is great. Okay, well, we'll put all that in the show notes. And I sincerely appreciate you joining us today. Is there anything else you want to give us for any tidbits of information, any insight that we should know about?
No, first of all, Tony and Cameron, I appreciate you having me on here. It's always good to get out here and, talk shop and talk business and how we can help people. And the only thing I would do is just people listen to this is challenge them. I mean, go and get uncomfortable. Go try to, do something that doesn't feel right or doesn't feel like that, the norm, I guess, is a good way of putting it. And just get out there and call us and like, here's what I got. How can we do this? I mean, the good part is, like you said, back 20 years ago, there was no social media. There was not a lot of education that's out there. Go and get yourself just educated. I mean, there's a lot of
just
groups.
Coming to you alone is, with your experience, someone could come to you in the education. You're going to wish you showed them today. And every time someone brings you a deal, I'm sure they get educated. So that's hugely helpful. So thanks so much. And without risk, there is no reward.
100%. Thanks again. Hey, you guys, thanks for watching.
Thanks, guys.
Talk to you soon. Have a great day.
Bye.